Ladies and gentlemen, good day, and welcome to the Escorts Limited Q1FY15 earnings conference call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Raghvendra Jaipuria of Perfect Relations. Thank you, and over to you, sir.
Hi, good afternoon. Thank you for joining us on Escorts Limited Q1FY15 results conference call. Today we have with us Mr. Sridhar, CEO, Escorts Agri Machinery, Mr. Ajay Sabrani, CEO, Escorts Construction Equipment, Mr. Dipankar Ghosh, CEO, Escorts Auto and Railway Products, Mr. Bharat Madan, Group Financial Controller, Ms. Jyoti Khaduka, Head Treasury, Mr. Saikal Mukhopadhyay, CFO, Escorts Construction Equipment, and Mr. Rajiv Das, Vice President, Corporate Affairs and Communication. We will start the call with the brief opening remarks from the management, followed by an interactive Q&A session. Before we start, I would like to add that some of the statements that we make in today's discussion will be forward-looking in nature. At this moment, I would request Mr. Das to make his opening remarks.
Thank you, Raghavendra. Ladies and gentlemen, a very good afternoon to you all. Thank you for joining us on the first quarter conference call for financial year 2015. Just one minor change before I go into the details. Mr. Ajay Sabrani is not with us today, but is represented by Mr. Saikal Mukhopadhyay, who is the Chief Financial Officer of our Escorts Construction Equipment business. Unlike the earlier times, I would like to dive in straight with our operating businesses and comments and presentation on that, and then round it up with a group perspective during the course of this call. Starting with the agri machinery business, our tractor volumes were up sequentially close to 15% for the quarter, although lower by 8% correspondingly. The industry also has degrown by 2% in this quarter compared to last year. Industry degrowth is attributable to the subnormal rainfall in the northern and central region and the unusual weather witnessed at the start of the quarter. To give you some perspective, our strong markets, which makes up close to 2/3 of the industry volume, degrew by 7%, and the weak markets, which contributes the remaining 1/3 of the industry volume, grew by 11%. As mentioned in previous calls, we have almost vacated the sub-30 horsepower segment and aim for a market leadership position in the higher HP segments. In this regard, industry in the 50+ HP segment grew by 5.7% and now contributes 11% to the overall industry tractor volume. In this growing segment, Escorts registered a robust growth of 66%. The FT6055 model in this segment alone sold 787 tractors against a zero-base volume. This model, along with value addition in the existing models, underlines our endeavor to command a leadership position in the higher HP segments. It is also encouraging to see an uptick in our export market share, which has increased to 3.1% from 1.7% last year. Tractor inventory at dealerships has been brought down by 983 tractors. This was done keeping in mind the anticipation of a weaker monsoon. As mentioned in our earlier calls, our focus on material cost reduction is being monitored very closely along with the external consultants, and we are confident that this fiscal year itself will see a significant addition to our bottom line on the cost reductions that will be managed on our material front. Credit finance facility to tractor customers will see a significant enhancement with a tie-up with Larsen & Toubro Finance, and will be a key step for adding to our customer reach. The recently concluded budget was positive for the agriculture sector, with government announcing an outlay of 8 lakh crores for agri credits for improving farm productivity through farm mechanization. Such initiatives will help shape the sector for a more sustainable growth in the future and also provide the much-needed impetus for industry participants and farm mechanizations. I now switch to the construction equipment business. The volume remained flat versus last year, but the revenue increased by 11% and stood at 121 crores. This increase is a reflection of our focus on better product mix and realization per unit. Also, when compared to the last quarter, our volumes increased by 42 units and the income was up almost 10%. Focus on premium and differentiated products along with prudent cost structure and rationalization has helped improve our margins both at a corresponding and on a sequential basis. As discussed in the last quarter, we have engaged with consultants to bring down raw material costs. In the current quarter, our losses came down by 30 basis points versus last year and by 150 basis points when compared to the last quarter. We will continue to develop and offer innovative products and move up the value chain in this area. This, along with the ongoing cost rationalization activity, gives us the confidence to perform better than the industry in the fiscal ahead. Lastly, new government's focus on building the country's infrastructure will further boost the prospects for the construction equipment sector and aid Escorts Limited in consolidating its position in the infrastructure machinery space. Coming to the Railway Division. Railway Division stands to gain from the renewed focus of the government on reviving the rail infrastructure in India. Railway Board's finalization of the wagon tenders has given impetus to air brake requirements. Also, the potential introduction of high-speed and long-haul trains and the dedicated freight and passenger corridors augurs well for our three main new products. Looking at the quarter performance, the revenue of 43 crores was down by 5% as compared to sequentially and 20% correspondingly. EBIT at rupees 1.63 crores is that of 4.84 crores sequentially and 5.42 crores correspondingly. The order book of approximately 33 crores stands to be executed in the next coming quarter. The Auto Division reported a revenue of 23 crores, down 25% sequentially and 38.6% correspondingly. The loss during the quarter at 9.2 crores as that of 7.1 crores sequentially and rupees 3.4 crore in corresponding quarters. We continue to evaluate partners for this business, however. To reduce losses, we have introduced the VRS scheme to rationalize the blue-collar manpower cost and will further bring it down to industry standards within the next quarter. I now turn to a brief look at our group financial numbers before we turn it over for a question-answer session. The turnover for the quarter increased by 15% to 1,129 crores sequentially and down 4% on a corresponding basis. The material cost as a percentage of sales was maintained around 72%. Employee cost of rupees 116 crores decreased as a percentage to sales by 100 basis points compared to last quarter. Other expenses, however, were up by 48 basis points sequentially and by 173 basis points correspondingly. EBITDA up by 24% sequentially to 57 crores and down by 38.7% correspondingly. We continued to bring down our debt, resulting in finance costs down by 34% compared to last year to 13 crores. Our total debt outstanding as of June 2014 is 376 crores. The PAT was reported at 34 crores for the quarter ended June. Ladies and gentlemen, now I request the moderator to open the floor for question answers which the team will ready to comment on. Thank you.
Thank you. Participants, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question at this time, you may press star and 1. We have the first question from the line of Mithil Shah from Karvi Stock Broking. Please go ahead.
Yeah, good afternoon, sir. Thanks for my question. My question is on the tractor industry volume growth. In the CNBC interview, Mr. Madan said that expects 3 to 4% growth for the second half. And hello?
Yes, go ahead. We are listening to you,
yes, sir. For the first quarter, we already reported, industry reported 2% decline, and for the second quarter, so it's expected to be decline in the range of 5 to 6%. So that means that for full year, industry will decline in the range of 2-3%?
Okay. Hello?
Yeah.
So, Mr. Shah, see, the way we should see the first quarter itself is explicitly 2% down. Actually, the segment, what you have seen, what has grown within that is the micro tractor. That means the Yuvraj types. That is something like less than 20 horsepower tractor. If you provide for that, then the industry growth will be further coming down to something like -5%. To that extent, it was on the expected lines. The 5% down expected. This is what we have discussed in the last Concall. So this was on the expected lines. But what we did expect was something like marginally positive, some 3% types kind of a thing we expected in the second quarter too. Now the way it is happening with the 51% sowing, whatever we have seen, looks like it may not be even 3 or 4%. The best estimate can remain as 0 to 1% kind of a types. So to that extent, industry will go through the moderation. You can also see CRISIL and all other reports are also validating the same thing, whatever we expected it. So the second half, the growth rate can still be around 4% because there again, the quarter 4 was very low. So with that, we should expect overall it can be something like 1 or 2% kind of a registration is what we should expect for the entire year.
Because sir, again, first half base is very high, so if we decline on that base and even if we grow by 3-4% on the second half, so overall industry growth comes down to -2-3% kind of thing.
Still, we really don't know. The quarter 3 and quarter 4 growth can still be very high. The quarter 3 growth can still be like, as I said, is 2-3%. We really don't know. Still, we don't know the monsoon, what will be the impact. So the base rate, what you are saying is correct. The quarter 1 base rate was something like a 26%, which was very, very high. Against that base rate, it is like even if it is -5%, it is not all that a bad shoot. If you look at it that way, it's not really bad from a 26% growth rate of last year. Okay, so if you look at it that way, it is going to moderate, it is going to come down. Yeah, it can happen that way. I cannot say. It will be something like a 2% types is the best you can expect for the whole of this year actually.
And for the higher HP segment, what is your view in the second half? The growth will come from the higher HP side will be or really across the segments?
See, if you look at the higher horsepower segment, in any case will, on a long-term point of view, it is here to stay. This is what we have shared 2 years back and the same thing we are sharing now also. What started small, it started growing. And I think other than the micro tractor, the biggest growth is happening only on the 50 horsepower and above. And we also made a commitment that is the segment where we said we want to be the leader, possibly in the year 15 and 16 was our explicit commitment. In that way, I think 3 years back from a market share of 1-1.5%, we become 3, 5, 7 and then this year the plan was to do something like 11%. We are already achieved that in the quarter 1. To that extent, the higher horsepower segment, we are on our way. There is no surprises there. But what is most important is the segment one thing below, which is something like 45 to 50 horsepower, where we did have some huge market share, something like a 21-22% types, some 5 to 7 years back. And that has come down to 16.5% today. So that is an area where we do have a lot of action plan. We are hopeful of reversal of trends there.
Yes, sir. Thanks. The second question is on the regional mix. In the first half, in the first quarter, we have seen South growing by around 10% and all other segments like other regions, North, Central, decline or remain almost flat. So for the second half, if we are expecting industry growth of around 3-4%, so which regions you do expect to grow?
Okay, I think in a way it's very difficult to guess. Still, let me try to give you some assessment. First thing is in terms of share data. The last quarter, the area where we operate, what we call our strong market, something like 60% of India, was growing at the rate of 35%. Whereas the weaker market, the 40% of the rest of India, which is something like Gujarat to south of India, including Bengal, this we call it as weak market. And that was last year, same quarter was growing at 11%, continue to grow at the same rate of 11%. There is no change in that market. Whereas our strong market from 35% has come down to a -7%. In a way, it's a shock to our own segment. But having said that, there is one advantage where we operate. The half of this area is also an irrigated area. To that extent, I think it has a better ability to absorb shock. See, for this reason for my quoting this is, if you look at it, states like Tamil Nadu or states like even half of Maharashtra, they were dropping like 30-35% year on year for 2-3 years. Those kind of things we should not expect in our kind of a market because of better irrigation facility. I would expect a much more moderate stand. From -7, it should almost become marginally positive, if not very high.
Yeah, because the South and Western, despite reporting higher growth last year, still base is much lower as compared to last 6-7 years level. So there is high probability this region would outperform or the industry growth would come from these regions. So what we are doing, sir, anything in terms of improving market share or strengthening the position in these regions?
I think exactly 3 quarters back we have talked about an initiative to de-risk the company because the zone where we are operating, if it becomes vulnerable, what happens is just as business de-risking activity. We wanted to take a couple of major states in South and West, and we wanted to crack. I think to tell you explicitly, we targeted Andhra and Maharashtra, for example. 3 quarters back, we started an initiative in Andhra. We did it in concerning something like 15 dealerships and 10 districts. And those areas, after 3 quarters, against an industry growth of something like 8%, our growth is some 30%. The reason for quoting this is that means whatever formula we have tried out on those kind of markets seems to be working. Now we have to scale it up. Scaling costs for first thing is money and as well as the time. We don't want to upset the overall Apple cost. So over a period of 2 years' time, we will take it to the 2 states, which is Andhra and Maharashtra, eventually spread it to Karnataka and other major states. So we are into an action plan. The way we have already discussed, this for us to see an end benefit, it is a 2-year activity. It cannot be anything less than that. But the initially it's showing some success. In the 3 quarters, the 10 districts of 15 dealerships is showing a huge success, if I am to say so.
So my last question is on the construction equipment business. The revenues are up by around 10-11% on YOY as well as sequentially, and even average price per vehicle is also up by 6% on a quarter-on-quarter basis. Still losses are almost in the same region, and when last conference call you highlighted that losses because of some annual adjustment and which will not continue going forward. So still the loss remain close to 9 crore as compared to almost 10 crore last quarter and around 8.7 previous corresponding.
Yeah, Mr. Shah, while the realizations have gone up, the number that you see as far as EBITDA losses are more or less on the same front because of certain exceptional expenditure that we are incurring to improve our bottom line. While the variable and average costs we are on top of it, but over the next 3 months or so, the exceptional item of cost that we are incurring at this point of time will go over. So while the realizations are up, within this quarter we will be over this expenditure.
So out of this 9 crore, what would be the quantum of that exceptional part?
So it's about 2 crore rupees. Okay.
And sir, what will be the break-even revenues because the losses combined the ancillary and construction equipment are close to 23. It's taking roughly 23-25% of the profitability of the tractor segment, agri machinery. So what would be break-even point, or when do you expect it to be turned around?
The green shoots are starting to. We are seeing that, and this quarter we are, the initial part of it is getting, crystallized. But the main crux of it will come in the October and January quarter, where the things will come under the implementation phase. So that's the quarter to watch out as far as construction equipment business is concerned.
In our last conversation, Mitul, we had mentioned that January 2015 is our deadline for a very healthy break-even at the EBITDA level. We are internally targeting to try to achieve that in the month of October, November itself, as Shaukat has confirmed to you today. The industry volumes still need to grow a lot more than they have grown till today. We are seeing visibility in the material handling space where we are seeing visibility of growth, but correspondingly we have seen some degrowth in the backhoe loader segment. But having said that, we are geared in our back-end operations for new dealers and new coverage geographies with a new product, Digmax 2, which has been very successfully received. I do feel that, the target of getting to break even by October, November would definitely be met earlier than the earlier commitment which we had given of January 2015.
So what would be the break-even volume roughly, construction equipment side?
We should at about 300 volumes, which is about 50 crore rupees of turnover. We should be.
Okay, thanks, sir.
Thank you.
Yeah.
Thank you. Before we take the next question, a kind request to the participants. All are requested to limit their questions to one at a time. Should you have more questions, kindly come back to the queue again. We have the next question from the line of Arvind Sharma from Citigroup. Please go ahead.
Good afternoon, sir. Thanks for taking my question. My first question would be, what is the pricing scenario like in the industry? Do you see discounts rising or incentives rising, given the tractor demand has been weak, as you said?
Yeah. I think, of course, this is a characteristic of this industry. Whenever the industry goes through this kind of a negative growth, there is a lot of pricing pressure do happen. So that is prevalent for the quarter one. It really happened that way. But having said that, certainly we are moving our prices up from 1st of August. We'll be moving the customer prices up on an average by 5,000, which may be varying from something like a 2,000 to 8,000 kind of a thing, depending on the model. We are moving the prices up. This is here to stay. I think we are more interested in keeping ourselves steering clear of this kind of an activities.
But sir, have you seen an increase in incentives from the competitors?
I think here the level of activity is gone beyond the incentives. They are all in the advertising in the press. They are all putting it in the newspaper, crossing the prices actually. So it's all explicitly offered to the customers. See, if you look at it, if you look at the scenario today, excepting couple of brands, one is Swaraj and as well as Sonalika, I think the whole industry seems to be under severe pressure. People dropping market share heavily. So these things are bound to happen. These two brands are generally an entry-level brands which are attractive pricing and things like that possibly. So this is here to stay for at least 3 more months.
Okay, thanks, sir. My second question would be that do you see any increase in demand from the non-agri usage of tractors? Has it happened over 1Q, or do you see it happening over next 6 to 12 months?
See, the first thing is infrastructure. When the non-agri activity, the moment it goes up first, I think my own sister division will be the beneficiary. As and when the demand picks up, this kind of a tractor is a spin-off. This will happen with a lag effect of minimum 6 months. So I don't think I should count on infrastructural activity as a basis of tractor increase for the next 2 to 3 quarters.
Okay. Thank you, sir. Thanks for answering my questions.
Thank you. We have the next question from the line of Amyn Pirani from Deutsche Bank. Please go ahead. Mr. Amyn Pirani, you may go ahead with your question. So there seems to be no response from the line of Mr. Pirani. We'll proceed with the next question. We'll take the next question from the line of Aditya Makaria from JP Morgan. Please go ahead.
Yes, sir. Hi. You did mention that, you all are doing, you all are focusing more on the 50 horsepower plus segment, and also this segment, I believe, has grown while the rest of the 30 and 40 sub-segments have declined. So what could you attribute this increase to?
No, I think I see the point is one is the size itself is small. The direction itself is continuous. This is not a new phenomenon. This is a phenomenon which is witnessed for last 8 or 10 years now. So this is, in any case, is there. Okay. I think we do not, I cannot attribute as one packet on one immediate reason. This is a general trend actually. And from our side, I think we have got a lot of product initiatives. Whatever we have put it across, this is yielding results. So, on that segment, it started yielding results. And what we are keen is now is on the 45 to 50 category. That is where we are working now. Hello? Hello?
Mr. Makaria, do you have any further question? Hello, Mr. Aditya? So there seems to be no response from him. We'll proceed with the next question. That is from the line of Bharat Gyani from Reliance Securities. Please go ahead.
Good afternoon, sir. I just wanted to really understand your strategy on the auto ancillary side, because the kind of losses have sort of widened dramatically if we see the last 3 quarters, and it seems that our efforts towards increasing the revenues or bringing down the cost have not really worked out. Like if we see the losses have really widened from 3 to 4 crores to a level of about 10 crores now roughly. So what is really the strategy of the management on that side, if you can throw some light on please, and what break-even time do we expect from that segment? Thanks.
No, Bharat, I think the one other reason for the EAP not giving the desired number is obviously the top line, which you see the decline happening. From the last year also, the numbers which was about 31 crores, we're down in turnover to about 22 crores this time. So one of the key reasons in the division was the manpower cost, which we are not taking measures to address it. Now, we recently launched VRS scheme. We had announced in the last quarter Concall also that will be coming out with a VRS scheme to take care of this manpower issue. The manpower in this division is almost 20-22% of the total sales value, which eats away most of the margin which this division makes. So one, obviously, the driving of the top line, which will be one of the key priorities for the company. And second is in terms of bringing down this cost structure. So VRS is already on, so we are hoping by the end of this quarter we'll be able to address that issue. So I think on an annualized level, 10 to 12 crores of the manpower saving should happen from that effort alone. So from H2, you will probably see the numbers becoming better, both in terms of top line improving as well as in terms of the cost control, which will come into play by that time.
Okay, and sir, that's good to hear from on the employee side. But what kind of revenues, what is the strategy, as you highlighted in the last quarter, that you'll be focusing more on the export side and the aftermarket side of the business, but then it really seems not to be worked out. So, when do we expect the management strategy of turnover improvement to really play out in this segment particularly?
Primarily, as Bharat said, that we are going into a turnaround of that particular division. The major fixed cost portion we are taking care of through the VRS of the old legacy staff. And as for whatever we had talked about in the previous quarters about introducing new products and entering into new markets like the aftermarket of the export aftermarkets, we are going into that. And this has a lag time of around 3-4 months. We expect to see all those improvements and the new products and the new market entry contributions coming in the H2 of this year.
Okay, thank you, sir. That's all from my side. Thank you.
Thank you. We have the next question from the line of Mukesh Saraf from Spark Capital. Please go ahead.
Yes, sir. Thanks for taking my question. My question is primarily on your margins. So, obviously, on the farm equipment side, EBIT margins of 8.3% is low YOY. But if I look at your standalone numbers, if I look at your gross margins, and if I assume that is an indicator of your gross margins at your tractor business as well, I'm not seeing an improvement there despite a product mix improvement. Because if I look at your volumes, I see that the greater than 50 HP is more than 7% of your volumes now, and this was just 2% last year, same quarter. So product mix is probably improving in the higher HP, but I'm not seeing a gross margin improvement, and obviously the EBIT margin is also falling. So could you just help us understand this?
No, one of the reasons for EBIT margin falling is obviously there's some 0.5% increase which has happened on the material cost front, and like Sridhar mentioned just ago, we are increasing the prices from 1st of August to pass on that inflation. So it will get neutralized in this quarter. And second, in terms of overall cost, if you look at this general inflationary trend in the other costs, so the selling and admin costs both have gone up. SGS have really gone up in this quarter. So that's one area I think which we are controlling right now. So I think from next quarter you will see an improvement happening on that front as well. But again, depends if the industry continues to be in this manner. If this is really you're looking at a flat industry or a degrowth, then obviously there will be some pressure on the selling side, which will continue.
So the gross margin reduction, I would say, is only on the back of material cost, and that should go back to maybe 71% of sales from next quarter is what you're saying?
Yeah. Plus, in addition, we said we are also taking the help of external consultant, and we already undertaken a project. The mandate has been given to reduce the material cost further in the next 2 years' time. So that we discussed last quarter as well, and that project is already on. So the benefit of that project will start coming from Q4 of this year and will be more reflected in next year going forward. So I think that will be a major game changer for the companies when you see the margin coming back to the double-digit numbers.
But I mean, isn't there a positive impact of the product mix? I mean, despite the fact that maybe your material costs have gone up slightly, and again next quarter you will again hike prices and get it back in control. But your product mix should also reflect in some improvement. Shouldn't that happen?
Yeah, there is an improvement, but like Mr. Sridhar has been mentioning in the past also, now in this market which is not growing, the ability to pass on the material cost increases on our new products which have been introduced in this segment is very difficult. So once you see the recovery happening in the market, our ability to pass on those cost increases to the market will be very, very high. So as of now, that restriction is there, which is why we are actually doing some under recovery in those models in the higher HP category, which probably will be taken care of in the second half when we see some improvement happen on the market sentiment side.
Okay. That's what from my side. So thanks.
Thank you. Our next question is from the line of Shikha Gopani from Infina Finance. Please go ahead.
Hello.
Yeah,
sir.
Please go ahead.
Riken Gopani here from Infina. Sir, wanted to understand that this quarter your automotive division has seen a very sharp decline in revenues on a Y&Y basis. Given that whatever various automotive companies have reported on volumes, this has been a pretty good quarter for all automotive companies. So any reason why our ancillary business has declined so sharply this quarter?
Yeah, I mean the primary reason is that we are going for a massive restructuring through a VRS of the old legacy blue-collar worker. And as you would appreciate, once you go for this sort of a restructuring in the shop floor with the old legacy labor, where the overall operational efficiency and the productivity drops. And also, accordingly, what has happened is because of the fact that you have to create at times the conducive atmosphere for the people to take VRS, we had to let go of a lot of our top line along with the lot of disciplinary measures what we were taking in the shop floor. So that was the primary reason. We hope to recover in the coming quarter, and as I said in the previous response that in H2 we would be going back to black. That's the plan what we have as a turnaround for this division.
Okay. So what absolute number of people, how many are being given VRS in the automotive division, and what is the total number of people today?
Total, we are planning around the total number of people would be in the range of 550 plus. We are targeting around 250 to 300 people VRS that we are targeting.
Okay, and this is, just to understand this better, this VRS plan is in order to curtail this business overall, or what is the plan here? I mean, is it that we were overstaffed, or, I mean, just wanted to understand why is such a massive exercise being undertaken here?
Yeah, primarily we were overstaffed. There is a huge fat out there, so we are cutting down the fat. We are becoming lean. We are trying to improve our operational efficiencies. With that, that is one of the major portion. As in a previous response, Bharat also said that we have almost 23% of this fixed cost as the overall manpower cost. So that we are trying to tackle down through this massive VRS scheme. And if we are able to tackle, which we are confident that this quarter we should be able to close it, then we would see a subsequent reduction of almost 12 crores in the fixed cost, and that itself would be a huge turnaround story for us going forward. Parallelly, as we do this, we are also getting into new markets and new products. We are introducing new shock absorbers and TFFs and all other new products. So we feel that the next H2 would be the actual turnaround of this division. And parallelly, we are also working with a new European technology partner with whom we are trying to not only enter into their home markets to contract manufacturing, but also getting technology for active damping, which would be a new one if once we introduce it to the Indian markets.
Okay. Okay. One question on the construction equipment side. Again, is there a similar point that we are doing, that we are cutting employee expenditure there, or what are the various areas where we are basically focusing on for improvement there?
See, the cost, looking at cost is a continuous approach, whether it is, the raw material, the other costs, or manpower for that matter. So that the process is continuous. Yes, we are looking at all fronts as far as reduction is concerned, including manpower.
Okay. Okay.
And just to add on to that, we have employed a very good consultant as far as looking at each and every process of our cost is concerned. So, whether it is manufacturing cost, whether it is, the raw material procurement cost, or also the right staffing at the various places that we have, all those things are getting, revisit, and in a period of, say, a quarter or so, we should be able to optimize all the areas of cost that we are looking at.
Okay. Sir, overall, for the group, in terms of whatever staff cutting that we are planning to do, what kind of VRS expenditure would that entail in terms of a one-time expenditure that you might have to do?
It may range from 25 to 35 crores.
Okay, that's
depending on the number of people we take out.
Okay. Okay. Got it. Got it. That's it from my side. Thank you.
Thank you. Our next question is from the line of Nikhil Deshpande from Sharekhan Limited. Please go ahead.
Good afternoon, sir.
Good afternoon.
As per news reports that you're looking at a strategic partner for your ancillary division. What kind of partnership are you looking at, and could you update on that?
Primarily, we are looking for someone who can bring in new technology, and also we are looking for partners where we can get into new components for this big auto ancillary division. Big auto ancillary markets. So the two things what we are looking for is one, high technology, and second is new products.
So you could be looking at some JVs or something like that going forward, or how is it?
Yes, we are open for JVs. We are talking to some of our European partners. So once things crystallize, we may also go in for a joint venture.
Okay. Sir, and could you update on what is the capex you are looking at for FY15-16?
This year is about 100 to 110 crores total.
Okay. Okay, that's all from my side. Thank you.
Thank you. Anyone who has a question at this time, you may press star and 1 on your touchtone telephone. We'll take the next question from the line of Aksh Vora from Praj Financials. Please go ahead.
Yes, sir. In Jan quarter, I think so, we said that we are aiming to double the market share in South and West from 3% market share to 6% and total into 11 to 12% in 2 years' time. So where do we stand right now, sir?
No, we are, the actual situation today is, excepting Andhra Pradesh, where we are still at 3.5% types, all other places we are actually losing market share. In other words, whatever from 4, 4.5, this is something like 2.5, 3, this is what is the current situation. Okay, but having said that, we said that the way to reverse is not working everywhere. For example, this area was also an area of vulnerability for our company. We have been operating without any good product, good structure, good strategy, and net result was we were also losing money. The credits, people not paying and all that. Today, I think fundamental cleaning in terms of removal of inoperative dealers are done, and the company credits to those kind of dealers were almost close to nil now, very negligible. People are operating with their own money. So the hygiene kind of an activity is already done. Definitely in Andhra, large extent in Maharashtra, some other area also it's going through. So those portions are already done. So the next, what we are trying to do is an appeal. The new product, whatever we are talking about, new solutions, what we are trying to talk about, is what is being done. This is what I have said is, even within the state, first we have started off only with the 10 districts or 15 dealerships types. And those areas are showing a very good result. Slowly we will spread that into Andhra. So this is the way we wanted to take it to a national level market share, which is something like a 10.5% kind of a types for Escorts. That should happen maybe over a period of another 3 to 4 quarters, and we will spread it out to other places over a period of time.
Okay. But sir, what kind of products are we dealing into South and West? Means are we going into higher HP tractors, or what is the demand kind of over there?
Okay, the South and West is generally a higher horsepower category as well, because these markets are also belongs to higher horsepower. To that extent, we are not creating a product which is very different for South. It's not that. Whenever we develop a product on 45 to 50 and 50 horsepower above, this naturally suits this market, and it is designed that way. Mostly important is, if I am to give you some perspective, from instead of a general market, we are all creating a specialized products. Just to give you one example, like tractor on top harvester, which is very, very popular in South. Now, this is a near monopoly of John Deere for those kind of products. This is what is happening today. Now, we are launching a series which is called a Fallen Crop Specialist. So, this is a very different product proposition, which only our product can do. So, those kind of activities are based on application-based, district-based, market-based, we are applying. So, this kind of activity is, I'm just giving you one example. Many activities are that way. So, eventually you will see a result.
Okay, and so can you just give the breakup from 30 to 40 horsepower, 40 to 50, and 50 above horsepower, growth kind of breakup?
See, all this 30 to 40, 40 to 50, all the growth of this industry is almost like a 0, -1. These are all either stagnant or a fall. Okay. There is not a great story. Whereas we said it's 50% and above, there is a growth story. Less than 20 horsepower, something like a 40 to 50% is the growth rate. Very high growth is happening at that level, more through government support. So this is what is the current scenario.
Okay. And sir, on the margin front, we've seen a significant reduction in the margin front. So what would be the sustainable margin going ahead in next couple of quarters? I understand there is a degrowth in tractor industry as a whole. But what would be the sustainable margin as far as we going for cost reduction and all sort of things? So according to you, what would be the margins going ahead in the FY15?
Very difficult to put a number on what will happen to quarter 3, quarter 4, what EBITDA prediction is very difficult. But what we can always indicate is the projects, whatever we have, for example, like we have supply chain project was flagged off. Like the way ECG, the construction equipment was done with the BCG, and then the tractor division we have, McKinsey is the lead team which is trying to do. It has a 2-year tenure. It has an explicit agenda of making it something like a 72.5% material cost, bring it down to somewhere around 68%. These benefits are expected, but it is expected over definitely not in this quarter, very small on next quarter, and then onwards the substantial benefits are expected. This is one way. Another area where we are trying to do is a huge staff reduction program, which is already we have done it. Now it's on white collar, blue collar, everywhere we are somewhere around 8.2, 8.5% what we have. Certainly there is a scope of bringing it down by another 0.5% to 1%. Actions are on, but the results will take a couple of quarters. These two are just to give an idea of what are all the possibilities, what are all initiatives are already underway. Now, we also talked about today 25% of our business is by the new products. Okay, last time also we have spoken about it. 25% is by business, new product, and then we are not in a position to recover the whole money. This is where we said when we launched this program by November and December, the growth rates were very different. The whole thing has changed in February and March. So we were to go slow. We said that still over a period of 4 quarters, we said we will recover that money. So we are into it. So end of 3rd quarter and 4th quarter, hopefully we should also be in a position to recover that kind of an additional money and also achieve certain cost reduction initiative, either it is a manpower or material cost initiatives should start showing results. So in terms of percentages, we have been hovering something like 9.5 to 10% comfortably. So certainly we should exceed those kind of marks quickly. And then the eventual goal is to further climb 12, 12.5, 13%. We will move. But precisely when it will happen, it also depends on how the industry is going to behave. So this quarter is an area, this quarter is a quarter to watch. So maybe by quarter 3 and quarter 4, we will be in a position to give a much more realistic estimate.
Sure, sir, I understand. How is
Sorry to interrupt. Mr.
No, there is the last follow-up question, sir.
The last. Okay.
So just to have a good proper view, how is the July month panning out as far as in all the regions?
No, I think I don't know about industry. Whatever we hear is the best estimate could be a flat estimate.
Okay. And lastly, sir, are we sticking to our goal estimate of margin to 15% on 3 years time of period?
Of course, that is why we are in a hurry.
Okay.
What we could have done it a little more leisurely in terms of cost compression, working more on the pricing part alone. Now we are rushing through all those initiatives, trying to target in the next 2 years. So end of a 2 year, what we are talking about, we are gearing up, going very close to that. That is why. But all this initiative has, it starts very slow and then grows very, very exponentially. So in 2 years from now, we are still targeting those kind of a margins.
Okay. All the best for the future. Thank you.
Thank you.
Thank you. We have the next question from the line of Vinay Nair from Rare Enterprises. Please go ahead.
Hello. Hi, this is Amit Goyla.
Amit.
Hi. Could you just explain your auto strategy once more? Because I see 23 crores of top line and 9 crores of losses. Could you just explain your auto strategy again, please?
The auto strategy primarily is that we are initially taking care of all the fixed costs, the huge additional fixed cost what we have. We are cutting down the fixed cost primarily by giving a VRS to the old legacy labor of what we have. And parallelly, we are also introducing some new products like new shock absorbers and new TFFs, and we are entering few of the new export aftermarkets in Europe and also in the Middle East. And the third part is that we are bringing in 2 technology partners, one from Europe and one from Australia, who has technology for high-end active damping shockers, which we do not have. And with both of them, the arrangement is that we are talking about contract manufacturing for their home markets also. But all this contract manufacturing and this new markets will primarily crystallize in the H2 of this year. This half, the previous quarter which has gone, and in this quarter what we are in, we are actually focusing on the cutting down the labor cost and also the operational improvements to bring about contribution changes.
Thank you. So you are looking at similar losses in the current quarter also?
It will be similar because as we go through the VRS as a process which takes almost 2 months, 1.5 to 2 months. So in this 2 months, we will not be able to bring in any major change from the previous quarter.
And in H2, you feel like your technology, everything will be in place, and you think the picture will change dramatically?
Yes, that's what we intend to do.
Okay. Thank you.
Thank you. We have the next question from the line of Vanil Shah from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. So, firstly, can you give me the number of construction equipment units sold for the quarter and also for the corresponding quarter last year?
It was the same, Anil, 719 and 718. So, from a volume perspective, there was not much of a change in the correspondingly 2 quarters of last year and this year.
But on terms of ASP, we are seeing a significant jump. Is that a measure of the product mix improvement, or have we taken any price hikes in the same?
See, definitely there was a price correction which we had implemented in the last quarter of the financial year of the previous year. And there has been some improvement which have been accruing on part of the cost initiatives that we have taken. So combined both of them, we are getting a positive result on that account.
Okay, so my second question is, if we look at our major states like Bihar, MP, this is for the tractor segment, like Bihar, MP, UP and Haryana, we seem to be losing market share vis-a-vis other players. So are we seeing some structural change in terms of competition or pricing pressure on those states?
No, I think Bihar we are not losing. Madhya Pradesh, I think we have Chhattisgarh as an area continue to be our weakness. It is continue to be a very low market share area. Same time, it's a growing area. So we do have, Chhattisgarh behavior is more like an Andhra behavior. Some of our activities, whatever we are planning, also will get replicated in Chhattisgarh. So some actions are on the cards. But more importantly, Madhya Pradesh also, accepting the area, no, it is things are not really good. The market which is growing even in Madhya Pradesh is that micro tractors. That is what is showing like a growth. Otherwise, conditions are bad only.
Okay. Okay. So we are not seeing any structural change in terms of competition and pricing over there.
No.
Okay. Thank you. That was all.
Thank you. We have the next question from the line of Kaushik Poddar from KB Capital Markets. Please go ahead.
You just said that you'll be giving a lot of emphasis on this or coming out with new products for this 45 to 50 horsepower in the tractor segment. What is the percentage share in the whole tractor mix portfolio? I mean, this segment constitutes what kind of percent in the total tractor market?
See, this is, I think, little over 25% of the industry lies there. See, we talked about the top end is 5 to 7%.
Which is over 50 plus, is it?
Yeah. This over 50.
Okay.
This 45 to 50 horsepower is a significant category. This is something like a 45 to 50. 28% precisely is for Amba. 28% may be the industry. But this is important for two reasons. Because this is the segment which Escorts historically used to do very well. We used to have something like a 21, 22 types industry 7 years back. And then we have lost it and a lot of competition here. And this is, currently we are at 16.5%, 16 to 17% kind of an industry, market share is what we have. The entire initiative, whatever we are putting it to, in addition to the over 50 horsepower is this category. A lot of actions are already on. We are not planning. A lot of things are already on. But we needed to consolidate and reverse. This market also is significantly south and west market. So a lot of challenges we need to come out. But all that what I can tell you is this is also another important focus segment for us.
Excuse me, sir. He's just out of the queue. We'll take the next question. That is from the line of Saket Kapoor from Suyash Finance. Please go ahead.
Yeah. Good afternoon, everybody. Hello.
Good afternoon.
So looking at the, especially the thrust the new government has put on the railway part, how well positioned is our company to get itself in that ecosystem? If we take the railway equipment as the segment in which we operate, how well are we positioned and what kind of figures are we getting from the railway board or any other authorities with related to this which are concerned with our company, because the railway is a big gamut altogether.
Yeah, I mean, we do see a very positive outlook for the railway market per se. We have two very important products like the bogie-mounted brake system and the axle-mounted disc brakes, which we have introduced. The bogie-mounted brake system is also on the anvil of crossing the field validation trials. So there we see a huge market potential because the previous government was actually for almost 1 to 1.5 years, there were no wagon tenders. That's one of the primary reasons that Q1 we did not have much to build, because one of our major customers are the wagon builders, and the last 6 months of the Q1 we did not have much tenders coming out. But as we speak, we have quite a significant number of wagon builder tenders coming out. We see a very positive outlook, and with the products which we have now recently introduced and also are going to the validation trial, we feel that the Q3 and Q4 would be pretty positive for us.
So, if you quantify it on the turnover front, what ballpark figures should we look at, sir? In what kind of revenue we can book if those orders do 55?
So on railway, we do quarterly about 40 to 60 crores is the range which we do every quarter. So I think that's the number which will be there in Q3 and Q4 as well.
Okay. So that would be the ballpark you are telling. That should be the ballpark.
Yeah.
So then why the EBITDA level was down, sir, in the railway equipment part? It was around 4.48 crores for the March quarter, preceding quarter, and it was 1.62 for this quarter, although the turnover remained flat sequentially.
The one, obviously, the turnover was one of the reasons, because it went down from 45 to 42 crore. And second was the product mix, because we supplied some couplers, which is a major order for this quarter, which we supplied with the margins for less. So that's one of the reasons which has impacted the EBIT margin for railway business this time. But going forward, that will get corrected. So I think we'll see it going back to the normal margin levels.
normal margin level. Sir, what is the update on the auto ancillary new partner or JV being signed? Where previously we were getting some feelers from the management that we are looking for somebody joining the company, or it is getting hived altogether. At what stage are we, sir, in that implementation? Although I have joined late in the conference, so I didn't get the earlier part correct. So just wanted to get myself corrected.
Primarily, as we look for partners, what we thought is that we should cut down the fat which we already have. So we are internally becoming very lean by going in for a massive VRS restructuring scheme, where almost we are targeting around 300 people of the old blue-collar legacy worker what we have. And we are putting in a lot of operational improvements where we can do a turnaround story. As we speak about the turnaround story, we are open for all other different technology partners coming in and forming a joint venture. As of now, we have just kept the hiving off portion a little bit distant. Primarily, we are looking out for a turnaround by one, cutting down the fixed cost, bringing in new technology, and third, we are expecting an European technology partner joining us in the coming quarters, where we can not only share technology for the Indian market, but also do a contract manufacturing for their home markets.
Okay. Fine. So on the interest front, sir, are we looking at this run rate only, or are we doing something more for the working capital management, and also that the interest cost will remain in this ballpark figure of 13-14 crore for the cost?
Yeah, it will be in this ballpark at least for this year, and then depending on how the cash flow is and how the profitability improves, so obviously then we'll look at the debt again. So some repayment will happen there.
Okay. Just one comment on the dividend policy of the company. So we see that in many corporates there is even if you take the PSU example, we have 25% of the profit being distributed as dividend in many of the PSUs. Do the management hold some view about giving guidance for what would be the dividend payout ratio as per the numbers declared, or it will be as per the board decisions only, and we will get to know only when the board decides? Or one can get a ballpark percentage. At this point, this is a percentage that will be the payout ratio.
See, at this point in time, the company remains in the growth phase. If you look at the kind of capex which we have spent in the last 3.5 years, we spent almost 400 crores plus of money on the capex side. And now we are also working on the turning around and cutting down on the flab and cutting down on blue-collar manpower, which again will involve a lot of investment. So as of now, the board has taken conscious decision not to put a formal policy into place, but they will take a call based on year to year, at least for another year or two.
That's from my side, sir. Thank you.
Yeah.
Thank you. We'll take the last question from the line of Viraj Kataria from Securities Investment Management. Please go ahead.
Thank you for the opportunity. Just have two questions. One is, if you can just provide some update on new agri-allied businesses which we're planning to venture into.
Sorry, come again?
The new agri-allied businesses which we're planning to venture into, so apart from tractors.
See, I think crop solutions is still too early. As I said, there's a lot of experiments, a lot of applications, studies are there, a lot of discussions are happening. I think it's too early. Let it become a powerful business case, then we will start unveiling it.
So, but any particular products, farm mechanization space, or anything particularly looking at within the farm mechanization space? So, any indication broadly of what segments we're looking at?
No, we said paddy as a crop is where we said we are working.
Okay.
So this is a very crop-centric approach is what we are working.
Okay, so be it the likes of tillers and the similar products.
Yeah, once we firm up, we will just share.
Okay, and second is you did mention in the previous answering to one of the previous participants' questions was the micro tractors, which is sub 20, has been growing at double-digit growth rate. So what is the real underlying demand driver? Because these are the kind of segments who are impacted more in overall downturn. So if you can just throw some insight on what's really been driving.
No, I think this tractors which are priced something like a 2 lakh, 2.25 lakhs types. These are all something like micro tractors. This is certainly growing. What was started as like what you called a Gujarat-centric or Maharashtra-centric market slowly is spreading to other areas as well. So having said that, these products have least profits because this is not a very profitable segment at all. So this is why what we have done is we have outsourced the entire activity to a different partner. Products are developed. We did sell some very small number, something like 150 types. This is not very significant. So many governments are giving subsidies and support to help these small farmers. All these things are there. So it's also being used for some light haulage purposes in the city. These are all the reasons what it's moving. But having said that, financially, still does not make a very big business case, at least for Escorts to get into directly. So we have an outsourced model. We will continue that way. See, our pre-occupations I have again been maintaining. This is about 50 plus, 45 to 50. These are all the categories which has got a big money and big potential, and we are chasing it. This is where we are.
When you say 150 tractors on an outsourced model, is it primarily the Ferrari tractors we're talking about, or it's actually the sub-20 tractors we're talking about?
No, I am not calling Ferrari into this kind of a thing. This I am talking about the way typically I call this 2 lakh types 2.5 lakh. Ferrari is something like 8 lakhs.
Okay.
There's a huge difference between Ferrari and this kind of tractor. I'm talking about typical micro cheaper tractor. I don't want to call it as a cheap tractor, but if that clarifies my, it's the cheap tractor.
But as a strategy, are we still focusing, even through the outsource model, are we still focusing on that segment, or are we gradually looking to vacate and focus on the high HP segment?
See, the Escorts will only focus. Focus means design, develop, manufacture, everything we will do only a profitable image segment which has a global opportunity as well. We will work on this. Whereas these kind of areas, sometimes it helps the dealer in terms of filling that portfolio. So those kind of activities we have identified a very good partner who makes a very good quality products. Those kind of things are there. But small numbers. This is not a focus number. So we do have something which is slowly, for example, on an average now 30-35 tractors are being produced and sold every month. This is as against competition will be doing thousands of tractors. There is a huge difference. But for a customer, yes, for Escorts, still does not make great sense.
Okay. And what is the volume of these tractors for FY14?
I really don't remember. This is something like 1,500 tractors you can say actually per annum, per month. This is the kind of numbers we should look at it. For example, in this quarter itself...
In last quarter, the industry was about 7,800 tractors in sub-20 HP segment.
Something like
which has gone by almost 41%.
Exactly.
In this quarter, was the last year.
No, I mean, so in Q1 it was around 7,800.
That's right.
Okay, and which is grown by 41%. And we target to have a volume of around 1,000 tractors per month.
No, we have no target. See, we do not, this is not a strategic segment. See, as far as we are concerned, we have found a solution. We have an outsourced partner. He is working something. We will give it to dealer. But we refrain from spending our time discussing on those kind of segments because financially it does not make a great sense. So we just stay away. It is a help to the dealer. We keep it that way.
Okay, and you did mention that government support is driving this particular demand. Yeah. So, given Q1 was primarily impacted by the whole election period, you still have seen a 41% growth in this segment. So, any other particular reason driving this particular growth, or?
See, the government support is nothing to do with the elections. It's generally what kind of subsidy they give it to a very small farmer. The assumption is very small farmers buy those kind of products is the way they have given. Predominant in states like Gujarat and partially in Maharashtra and now even places like Tamil Nadu and other states, northern states are also picking up. Okay. See, this is like the biggest constraint on this kind of tractors are if the pricing has to be razor sharp. Otherwise, people have no reasons to buy those kind of tractors. So this will always be under pricing pressure. So only when you have a marginally higher capacity, you can always do those kind of things we can do. As far as we are concerned, we don't want to block our capacities. So the whole thing is really outsourced. So it is done by somebody else in Rajkot for us.
Okay. That's all from my side. Thank you very much.
Thank you. I now hand the floor back to the management for closing comments. Thank you, and over to you.
Thank you, ladies and gentlemen. Before I finally close the meeting today or the discussions today, I just want to emphasize that the bleed on the construction equipment and the auto products business forms the top focus of the management for the next 9 months. There is no question about it that by the conclusion of either the third quarter in the case of ECE, the construction business, and certainly by the close of the fourth quarter of the auto products business, the endeavor of the management here would be to see that both these businesses stop being a bleed on the overall pressure on the margins which has been seen in this particular quarter. And across the spectrum of whether it is materials management, whether it is addressing the blue-collar reductions through our VRS schemes which are being very, very aggressively pursued, and whether it is building the business model, whether it is contract manufacture alliances which the auto products people are looking at very, very seriously. The attempt and the management focus for the next 9 months would be to make sure that this bleed is eliminated and it adds to the overall margins and profitabilities that we were looking for as our internal targets for the year. I would also just like to mention that we distribute our earnings release through our website, which is www.escortsgroup.com. So do refer to our website for our earning releases and other details that will accompany this call. Also, you can visit our social media pages for the latest company news, developments, innovations, etc. Ladies and gentlemen, once again, thank you for your time and being present at this conference call today, and we will meet again at the end of our Quarter 2 results. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of Escorts Limited, that concludes this conference call. Thank you for joining us. You may now disconnect your lines.